Hello folks, it is Thursday, June 22nd. It is about 4 o'clock on the east coast of the United States. Just wanted to do a quick follow-up on the interest rate video from earlier in the week. We got three more hikes today, and so that's what we're going to talk about in this video. Bank of England hiked a half a point. Expectation was for a quarter point hike. And then this was a quote from one of their talking heads, bringing inflation down, absolute priority, blah-de-blah-de-blah, 2% target. And as I've stated multiple times, this inflation, they're not trying to fight inflation. This is BS. But it gives them a good cover story to continue hiking rates. If they were serious about fighting inflation, they would immediately take interest rates up above the level of inflation, which currently in the United States we're at about 12%. If you use John Williams' shadow stats, he uses the BLS methodology from 1980, and he's currently tracking inflation at 12%. And of course, our BLS, with all their massaging and manipulation of the inflation rate, they want us to believe that it's only 4%. And of course, think about the last month or the last year, your experience in the grocery store, the gas station, paying your bills, anywhere where you're spending money. Does it feel like inflation is 4% or is 12% more realistic? You can answer that question for yourself. Swiss bank, they hiked a quarter of a point. That's what the market was expecting. Norwegian bank hiked half a point. Market was only expecting a quarter of a point. And so this is where we're at so far in the month of June. We have the Fed, they skipped. And Powell, in his talking today, made it clear that he never used the word pause. And so the Fed skipped. They're not at a pause. They just skipped hiking this time around. ECB hiked. Canada hiked. IMF is saying that interest rates will remain high through 2024. And they also said that the U.S. needs to hike another quarter point. UK just hiked half point, Swiss quarter point, Norway half point. So that's what's happened with interest rates so far in June. Notice that these are all Western banks. The fiat, I'm stating my opinion now, the fiat banks in the West have reached the end of the current fiat debt-based system. They have no choice but to raise interest rates in my opinion, they're not going to succeed, but what they're attempting to do is attract legitimate buyers of debt instruments. And people with real money to invest in debt instruments, they want yield. 0%, who cares? They're not interested in 0%. They want some serious yield. And in truth, they want yield that is above the inflation rate. And so we're not there yet. And so again, I restate my opinion, we are going to see elevated interest rates and rising interest rates for years to come. Now let's look at some charts. So this is the UK yield on the 10-year. We're in the monthly time frame. All of the charts of the Western 10-year bonds look pretty much the same. Long-term downtrend, in this case, UK, that's 1980, that's 43 years. And we can see that looks pretty much the same way as the US 10-year yield. Steady downtrend for 40 years. We reached, actually in this case, got down to, did it actually reach zero? Let's just look here real quick. The low 0.065. So in the 10-year, they didn't get the negative rates. That was, I guess, was on the longer term 30 and 40-year bonds. Well, the Euro issued a 40-year bond. I'm not sure whether UK did or not. No, actually, I believe they did. So anyway, almost 0%. And then, something changed. Clearly, this is a change in behavior. And I've put the same notes on all of these charts that we saw on the U.S. 10-year yield. This is the default. Chinese real estate company defaulted on $300 billion in debt back in December of 2021. European investors had some of that debt. U.S. investors had some of that debt. In my opinion, this kicked off the collapse of the Western debt markets, and that collapse is ongoing. March of 2022, this is when the breakout occurred in the U.S. 10-year note. And so I'm marking that point on all of these charts. So 40-year downtrend, that's in reference to the 40-year downtrend in the U.S. 10-year bond. In this particular instrument, I would say that the breakout happened earlier. That's August of 21. That was the clear breakout in this instrument. Notice that MACD is in bull mode, which suggests that the primary trend is to the upside. Energy is very elevated, so my expectation is that this debt instrument will continue to rise. And notice as well, if we draw a quick trend line, that interest rates have now, they haven't set a new high above this previous high, but based on these last two bars, I would call this a breakout above this level, this resistance level, and now a test of that level as support. Let's keep rolling. So this is the Swiss 10-year, same story, downtrend. This is only going back to 95, so we're talking about, what is that, 28 years? But clearly a breakout. Here we have the Norwegian bond. Again, back to 94. So again, 20 plus years, obviously a breakout. All of these charts, MACD is in bull mode, energy is elevated. Here's the Euro bond breakout, very rapid increase in the Euro bonds. Swiss, we already looked at the Swiss. Excuse me. Australian 10-year bond, clearly a breakout, and the German bond, clearly a breakout. And so any of these Western countries, when we look at the yield on their 10-year bonds, they were in a steady downtrend, long-term, multi-decade downtrend, and now the behavior has changed. We're in an environment, and again, we're going from facts that I've presented in these charts today back to me stating my opinion, multiple years of increasing interest rates. And that's all I've got in this update, folks. I will talk to you soon.